My name is Simon Barnard. I'm the portfolio manager of the Smithson Investment Trust. I've been an investor for over 20 years. I joined Fundsmith in 2017, and before that I was at Goldman Sachs for 14 years. Well, Smithson is part of the Fundsmith stable of funds, and Terry Smith, who runs the very successful Fundsmith Equity Fund, was once asked which were the companies that had outperformed his fund. And the only companies that he could find that he thought were worth investing in were actually small and mid-cap companies. And so that's where the idea came from, to launch this trust as a vehicle to be able to invest in those exciting smaller and mid-cap companies. Well, the trust is set up as a concentrated portfolio to invest in around 30 small and mid-cap quality companies for the very long term. And that would allow those companies to compound their free cash flows over time to maximize the capital gains for the trust. We have a very simple three-step investment process. We try to buy good companies, don't overpay, and then do nothing. And by good companies, I mean very high quality small and mid-cap companies that have strong operating margins, healthy balance sheets, very good free cash flow growth, but most importantly, have strong competitive advantages so that we know that over time, those great operating metrics can be maintained. And then in terms of not overpaying, of course, great quality companies are very rarely cheap. But sometimes when they are, for temporary reasons, perhaps weaker stock markets, then that's when we try to snap them up. And then in terms of doing nothing, what we mean, of course, is we aim for a very long holding period. So in our minds, that's 5 to 10 years, or as long as those companies continue to perform well. Now, in terms of investment ideas, the way that we come up with those is that over a very long time we have put together a list of around 90 companies from around the world, which are the only companies that we have found which fit our very strict investment criteria. And so over time we can research these companies one by one, and if we deem them good enough, we will add them to this list, which we refer to internally as our investable universe. The portfolio is then constructed from that long list into about 30 names. And again, we wait until they are at a valuation that seems reasonable to us before we add them to the fund. And I think a good example of a company that we have bought very recently is HMS Networks. This is a small Swedish company that produces devices which are integrated into factory machinery and modern buildings. And it allows this machinery and buildings to be monitored and controlled remotely, thus allowing them to be automated. So of course, in that way, their productivity can be improved as well as their sustainability. Now, HMS Networks is a very profitable company with over a 25% operating margin. It's grown its free cash flow over the last 5 years by 20% a year, and it's got a very healthy balance sheet with lots of cash. Performance has been good. So after fees, the trust has outperformed its reference index, which is the MSCI World Small and Mid-Cap Index, but over both the short term and the long term. So last year, the net asset value of the trust was up 13% compared to the index up 9%, whereas since inception 5 years ago, the net asset value has compounded annually at 9.4% versus the index at 7.7%. It's worth mentioning, though, that the trust moved to a discount a couple of years ago, so the share price hasn't performed quite as well as the net asset value. We're currently trading at a discount of around 12%. That's actually one of the tighter discounts in the sector, which is the global smaller companies sector, and the average discount for that is 16%. Yes, we do have a discount control policy. The board actively buys back shares all the time that the trust is trading at a meaningful discount. So that means since the discount opened up around April 2022, the trust was trading at a premium up until that point. But since then, the board has bought back over 11% of the trust.